Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me is Prashant Nair. Prashant, back on Trading Hour after a while.
It's been a while.
It's been a while.
Months.
Yeah, few long months. But for the markets, we've come off a bit. But just about 30 minutes back, the Nifty was up nearly 150 points. And now those gains have come down to about 70 points. So the Nifty is holding on to 22,000. But as you can see, from somewhere around 10:30, which was the day's high, the markets have come off. And that's, that sell-off, that profit booking has accelerated in the last few minutes. Now the week-to-date loss stands at 1.7% on the Nifty. On the mid-cap index, we're down close to about 3% for the week. The big gainers of the day on the way up, it's Hero MotoCorp. So that's holding on to the 3.5% gain tightly. BPCL, good numbers. The bonus issue, stock is up close to about 3%. And Asian Paints rebounds after yesterday's big loss. And we've got the management at 12 o'clock joining us on the channel. For the week, though, it's been all the, rural-facing names which have done very well. So Hero MotoCorp has gained 8+ percentage point for the weeks. HUL has been a big mover, 6% gain. There is a catch-up in FMCG names like Britannia, Nestle. So the gains have been concentrated in the under-owned, under-invested FMCG and even Hero MotoCorp, where there is some valuation comfort versus the peers on the back of this entire rural theme.
But, next couple of hours important and critical, right? Because after yesterday's sharp drubbing, going home with about a decent kind of a 0.5%, maybe a little bit more would have been good. Can still happen. So 22, so we're off about 60-65 points from the day's highest level. I just put out a sort of a chart if we have that, a quick sort of nifty look at what has really happened, right? I mean, I think from the start of this year, do we have that? I mean, just the supports that we put out in the morning as well, that graphic plate on the index. Essentially, what we're saying is that the market, the Nifty, has taken supports in January. There you go. That's the number. That's the chart that I'm talking about. And it really neatly captures, right? 21,137 in January, sharp bounce after that sell-off. Then in April, we hit 21,777, sharp sort of sell-off there into that low, and then a sharp bounce. And we are now, as of yesterday, we kind of almost got to it. Not quite. So 21,930-ish is that level. It's pretty close by, and it'll be good, about 70 points away from where we are right now. But it'll be good, 90 points away from where we are right now. But it'll be good if that kind of holds so after what we've seen from the highs of earlier. I mean, from the all-time high, of course, the market's come off just under 4%. All right, I mean, 3.7, 3.8% or so, that's about it. So let's see if there is more on the downside, or this is, in some ways, at least for now, it'll be good if this is it. And the market stabilizes and tries to find its own feet. Reema.
Well, let's head to one stock which we've not discussed. That's Intellect Design Arena, and that's seen a double-digit fall, 12% gone on Intellect Design Arena post the Q4 numbers. Now, one reason is the Q4 numbers are weaker, and two, the second reason is the stock has run up. In the last 1 year, it's given a return of 92%. Now, onto the numbers. The revenues are down 3.3% quarter-on-quarter. Year-on-year basis, revenues are absolutely flat. Compare this with the recent trajectory where the company has been clocking in a revenue growth of 15 to 20%. So the question is, why did the revenues fall off, so sharply this time? Well, the key factor is the company was executing a GEM platform, Global E-Marketplace. It was a platform that the company was executing, and that largely ended in the current quarter. So, we chatted with the management just to try and understand that how much was this GEM, contract contributing to their revenues quarter-on-quarter and on a year-on-year basis. So same time last year, in Q4 of FY73, the government e-marketplace contributed about 73 crore to the top line. Last quarter, it contributed 64 crore. And in the current quarter, it's come down to 8 crore. So that's the reason. If you strip out the GEM contract and do a like-to-like comparison, then revenue growth is up 13% year-on-year, and quarter-on-quarter, it's up 6%. That said, there is an improvement in the company's margins. The company did say that FY25 revenue growth guidance is at 15%, like-to-like, if you exclude the contribution of GEM in FY24, and they're looking to maintain margins between 20 to 25%. So that's Intellect Design Arena and what's resulting in the weak set of numbers. But moving on to Escorts Kubota, the stock is higher despite a weak Q4. The company's revenues declined. There was slowdown in the tractor business, though the construction and railway business is stable for the quarter. We chatted with Bharat Madan, whole-time director and CFO of Escorts Kubota. Listen into what he had to say.
So this quarter we expect, I think it will be a soft quarter for us. So we still expect it to be a single-digit degrowth, which will happen in the industry numbers. So May, June may still see a slow growth. I think going forward, once the monsoon starts, if the pickup is good and distribution starts, maybe the sentiment will start improving. So July, August maybe more like flattish month. September onwards, we'll see the pickup start happening. If we really see a good monsoon this time. So the festive season shifted this time to April, so that actually reduced the impact of the drop. But otherwise, the sentiments were not very strong on the market side, and then coupled with the election scenario, I think some demand has been injected. So we had given a guidance the margin for tractor will continue to be in 13 to 14% range. We won't see it dipping down, to single digit. All speculative. Actually, we denied that also to the stock exchanges. So there's no such news. Yes, we know Kubota is not really into the railway business globally. So it's not really a sector where they can add value. But that doesn't mean that it will be sold off. So obviously, we're looking at the right partner who can really help us in doing that business further.
Okay, Macquarie today has also upgraded Escorts to an outperform from a neutral rating, and they boosted the target price to 3,880. They say FY25 should see domestic tractor demand recovery, and even exports are likely to pick up in FY25. So thumbs up from Macquarie, target price 3,880. So a good 10% upside from current levels. Moving on now to the life insurance sectors. They've started FY25 on a strong note. LI's life insurance industry's April premium has gone up by 61%, driven largely by LIC. Yash Joinson with the details. Yash.
Well, Rima, if we look at April 2024, except for HDFC Life, all life insurance companies have performed very strongly on the premium collection front. But also what one needs to look at is April of last year, that is April 2023. That was a very favorable month, a favorable base for life insurance companies, only because a lot of buying of life insurance policies got advanced to March 2023 because of the taxation rules. Now, if one looks at, taking the base effect into consideration for the current April, that is April 2024, then April 2024 would be considered weak for HDFC Life in terms of premium collection, but good on terms of total APE growth and strong in terms of the retail annualized premium growth. April 2024 premium collection for HDFC Life has grown by 4%. This taking into account just 0.5% growth in terms of base of April 2023, which is weak. April 2024 APE growth stands at 21%, which is good. April 2024 retail APE growth stands at about 30%, which also is strong for HDFC Life. ICICI Pru Life April premium stands at 28%. Taking into base effect, the number looks weak. Total APE and retail APE growing at 36% and 72%. Weak total APE growth and strong retail APE growth for ICICI Pru Life. Max Life, again, the premium growth is 41%, which stands strong. Total APE growth at 35%, which is strong. And retail APE growth at 32%, which is again a very strong number, taking the base effect into consideration. Finally, SBI Life, April 2024 premium growing at 26%, which is a strong number, taking into the base effect. Total APE growing at 21%, retail APE growing at 20%, which would be considered weak if you take in the base effect into consideration.
Okay, all right. Yash, thank you very much for that. So that's life insurance data. The general data, the non-life numbers also perhaps should come sometime during the course of the day. We'll get you that as well. We'll take a quick commercial break here. What's happening in the commodity space? Manisha Gupta is going to be here with exactly that or top of mind. So that's coming up in a bit. Okay, welcome back. Well, let's shift focus to the commodities space now. By the way, I have to mention the market, the equity market, which was looking a little leafy with just 60 points, but it's rallied another 30, 35 points very quickly, back up 95. So, holding 2250 plus, 22,050 plus. But what's making news and what's top of mind for commodities? Manisha is here with that. Manisha, morning.
Morning, and thank you for that, Prashant. Well, I'm looking at overall commodities as a sector right now for this segment. The US dollar has softened after the US jobless claims data that came in yesterday, which is the highest in 8 months. And that in turn has led to US dollar softening. And that in turn has led to support in case of commodities. So when you look at the gold prices, we are up by 2% in this week. Overnight, actually, we've seen the gold prices gain up quite strongly. It was trading at 23.10 yesterday, same time. It's trading at 23.55 right now. So strong gains coming in for that one. Not just gold, but silver is gained almost 4% overnight. And we are looking at a 3-week highs when it comes to silver. Platinum prices with the jump are trading at a 4-week highs. Palladium prices gained up by 2% overnight. And that clearly has been the trend that you've seen in the other metals also. So copper prices very close to its 2-year highs with 1.5% of gains that we saw in the overnight market. Within energy as well, the crude oil prices have jumped up back above 84. Natural gas prices are trading at a 15-week highs. So everything, whether it's metal and energy, are doing quite well right now. Well, there also are statements from Bank of England signaling a rate cut in this summer. The US jobless claims has been a positive data as well for the bull buyers here. And then the street will watch out for the US CPI and the PPI numbers. Well, that comes in the next week. And ahead of that, you will see this choppiness continue in case of the dollar index. Markets are now betting on a 69% of a probability of a rate cut in September. This is much higher from 45%, which we saw in the previous week. And that in turn also has been supportive.
Okay, thank you very much for that, Manisha. Get into a break. On the other side, we'll discuss market technicals. Mitesh Thakkar will join in. Welcome back. Muthoot Finance is recovering. So after yesterday's fall, Muthoot Finance is now up close to about 3.5%. And even Sterlite Technologies, the stock reacted adversely to a weak set of numbers. Yet again, there was a loss in the quarter gone by. But today, some buying has emerged in Sterlite Tech, and that's up 4%. Mitesh is now with us for a quick technical check on the market. Mitesh, morning. Come off from the highs that we had about an hour back. Does that concern you? And what would your stocks be that you would recommend for trade?
Rima, good afternoon. Actually, that's the kind of view which I'm carrying, that basically you will now see the markets slightly be on the negative side and rallies will get sold into. So while, after declining straight away from 22,750 plus levels, you've come down to as low as 22,950, there would be a pullback. I think, you will see rallies closer to about 22,200, 250 zone getting, facing aggressive selling. So maybe a day or two, you will see some choppiness, but I think on the higher side, profit booking and supply will emerge. That is the view on the index.
And Mitesh, what about stocks?
Stocks, Prashant, I think I'll continue with my theme of buying into FMCG as a sector and selling the rest of the pack. So Godrej Consumer is something which I would recommend as a buy. Keep a stop below levels of 1300, look for a target of around 1385, 1390. And the other one is Hero Motors, which on the two-wheeler side is also looking a good sector to bet into. So Hero Motors is a buy with a stop below 48.40 and a target of 5,100 is what I'm looking at.
Just a couple more specific names, if you will, Mitesh. Bharat Forge, I don't know if you have a call or a view here. Day before yesterday, it had that big 15% move. Yesterday, had a 4% move, got sold into. Today, a bit of a attempt, 1.5% is now flat. Any thoughts here?
Bharat Forge, Prashant, I think, is something which I've had a very positive view and the structure on the long-term basis is good. After the numbers, we saw a big candlestick, and then what we have seen is that for next 2-3 days, it's turned sideways. So yesterday, it went up to as high as about 1460 and then came off to close at 1410, 12. It's today trading around those levels. It's a buy for me, but then only because of that candle which happened on the result day, which is Wednesday, you might want to see some pullback to get into the stock. So anything closer to about 1375, 1360 zones is a very good area if you can get the stock there to build long positions. I think eventually the stock is heading towards 1550 plus levels.
What about something like a Sonata Software, which has gone the other way since the results? I mean, it's down 4% today as well, under 500 now.
The only thing is that, Prashant, this week itself, the stock is fallen 26% and the stock is oversold, but the structure is very weak. So, you might see some support around the historical pivots of 485, 480. but I think rallies will get sold into. And I think now that gap area which happened on the result day, again, this 560, 570 zone will be very difficult for the stock to clear. So negative for me, but maybe, if somebody's holding it out, keep a stop below 480 on a pullback, try to sell closer to 560.
It's, I think from 900, end of February, it's basically from 900 to 500 in, I think, 2 months flat, 2 months and 10 days or so. So that's Sonata for you. That's a very sharp correction. And as Mitesh said, this week has been particularly bad for the stock as well. Mitesh, thanks very much. We'll come back to you for more, but take a quick break here. But we'll also get into a conversation with the CEO at Proximus. And we'll also have the management of Route Mobile joining in. Stay tuned.
Welcome back. Belgium-based Proximus Group has completed the acquisition of a majority stake in Route Mobile. The deal, remember, was announced in July of last year, but got consummated only 2 days back on 8th of May. And this is one of the largest deals that we've seen in the communication vertical. I sat down to chat with Mr. Guillaume, the CEO of Proximus, and Mr. Rajdeep Gupta, MD and CEO, about the contours of this transaction, but started the conversation with the FY25 outlook. Because when the company reported their Q4 numbers, Rajdeep had said that, I'll give you an FY25 guidance once this deal is closed. So we started off by asking how FY25 is going to shape up for the company and what visibility he has. Listen in.
If you talk about the guidance as of today, like we as a group, Telesign, Route Mobile and Proximus, I think we are still working on our strategy. We believe that the quarters is going to be definitely, the guidance is going to be definitely better than the last year. And there were some headwinds in last year, and we have seen some kind of a guidance changes from our end. But we believe that the kind of synergy we are working together, that will definitely help Route Mobile as a company to give better guidance coming very soon. But as of now, probably I will not give any guidance because as a team, we are still working on it.
You're not giving a number, but you are saying FY25 is going to be better than FY24 and the headwinds are receding.
Definitely, yes.
In terms of volumes, just to get some numbers to understand the big picture, what percentage of the volumes today for you are on SMS versus omni-channel? And what's the growth in both, or is SMS degrowing?
No, SMS is indeed growing. If you see
so what's the number in terms of growth?
If you talk about the domestic market, right? So there is a headwind definitely is from the international termination, okay? But every single region, wherever we are operating regionally, we have seen the regional growth in volume. Like in India, our domestic volume has grew almost by 15% last quarter. And that is where we have seen there is a definitely headwinds for international traffic, where some of the OTT players, they cut down their cost. But we have seen the growth on SMS as well for a domestic market, as well as on the omni-channel.
Okay. Near the new owner of Route Mobile, the Proximus Group has about an 80 to 83% stake in the company, which you need to bring down to 75% by in the next 12 months. What's the vision now for Route Mobile? Rajdeep in the past has spoken about the company achieving $1 billion. That's doubling of revenues from current levels by FY27.
Yeah, the vision is to serve on the market opportunity. I think Rajdeep just mentioned it. The need for interactions in between enterprises and end users is going to explode on the coming years. 90% of the companies will be needed our platforms in the next 2 to 3 years. So in terms of market demand, the market is there. Just our ability to capture that market trend, that is going to be the key of the success of Route Mobile and of Proximus Group as a company.
You want to take us through the math on how you hit $1 billion by FY27 from the current 4,000 odd crore?
So this is very simple, my math is there are certain regions which I operate as a Route Mobile. Like LATAM is a very big market for us. Africa is indeed a very big market for us, and India itself, like in Asia. So if you talk about the digital adoption, the way it is growing in all this market, and there is a shift definitely from SMS to omni-channel, but there are certain large deal wins which we have done in last few quarters. Like
Vodafone Idea.
Vodafone Idea is one large OTT customer, like one of the largest e-commerce customer we have onboarded. There are another few banks in our pipeline. There are certain strategy we're working with the local e-commerce company in different regions. I think we're very bullish about our growth, and that I think our overall combined target is $2 billion and 15% EBITDA target, which we have for 2 to 3 years down the line. This is what we are all going to work. But as for a Route Mobile, if you see, I think that $1 billion revenue dream is still there. It's not a dream, it's a reality for me. And I have a very clear plan how to achieve that. And $1 billion is something which I'm very clear how
and
I
15% margins.
15% margin is definitely a target for the group, and that is a target for me as well.
So talking about the partnership between Proximus and Route Mobile, the day you announced this transaction, the stock price fell. There was concern because you were selling your direct holding in Route Mobile, and you were investing part of that money in the broader entity, Proximus Opal. But the street took it negatively. So give me 3 reasons, just 3 reasons why this deal is accretive to shareholders.
Look at the synergies opportunity that Rajdeep mentioned. If you look at the complementarity of the 2 assets that we're bringing together, Route Mobile and Telesign and BICS tomorrow, you have 2 big brands. Telesign is super strong in the US and in Europe. Route Mobile is super strong in other geographies, and you can cross-sell the CPaaS capabilities of Route Mobile to geographies where Telesign is extremely strong, and we have direct relationship with a lot of customers. That's one.
So complementary geographical presence is
Complementary geographical presence, that's one. Second, product complementarity. Route Mobile has probably the best CPaaS platforms of the world. And with Telesign, we are bringing the best digital identity anti-fraud platform of the world, combining the 2 assets so that you can provide trusted, secured interactions in between companies and end users. That's super key at that very moment. So that's second reason for creating product synergies. The product complementarity is super important. And then, of course, you have the cost synergies. We announced that we will deliver more than $100 million of synergies, including cost synergies. A big chunk of that is going to flow into Route Mobile P&L. So, creating...
Have you put a number to that?
We will update with more numbers when we have our Capital Markets Day beginning of June. But you see revenue opportunity, because of the geographic complementarity. You see product complementarity because of the different types of product we will assemble in between Route Mobile and BICS, and Telesign. And then you have the cost synergies that are going to be massive, and that will also benefit to the Route Mobile P&L. So those are very good reasons and concrete reasons why I think the deal is going to be fantastic for Route Mobile shareholders going forward.
No, just to add to that, Rima, I think the number of OTT players, they all are based out of US, right? And we as a company, we are now one team. We have a certain great firewall deals in India and other part of the world. And we can now go directly to those customers which Route Mobile didn't have till today. With the help of Telesign, I can onboard many customers for country like India or other market where we have a firewall. So these are the strategy, these are the synergies we are working on right now, how to combine one team, and that those targets are very, very realistic, I can say that, and we are very positive towards that.
All right, well, that's an interesting conversation with the management of Route Mobile about business prospects going forward. We'll take a quick commercial break here. We've got the market, which is holding with a 100-point plus gain, 22,070. We are coming back with Manish Dangi of Mosaic Asset Management with a quick view on what markets look like. And of course, we'll talk about elections and how we are pricing and going into that one on the other side. Stay with us. Okay, strong day. Actually, relatively strong day, right? 100 points plus higher. 22,061 is where we're at. Manish Dangi is with us from Mosaic Asset Management. Manish, good morning. Good to have you with us here. Thanks for your time. So, what are you picking up, Manish? What's the market really trying to price here? Because last few days, at least equities have been a little weaker. We've sold off about 4% from the highs.
I mean, we are actually 6-7% relatively right versus US. And so this is all Modi anxiety, I would say. It's all in the grip of sort of super local macro and political macro, so to say. I think market needs a confirmation of its original prior that it had. And it's sort of, there are cracks in it right now, I presume, and which is what is driving right now. So if markets are possessed, I would say, it's nothing to do with economy or earnings.
I know, absolutely. But there's no way to, I mean, first of all, no one knows. The second, there's no way to sort of, given that there is no way to, put on a trade with that, even if you have a view, right? Except, of course, I mean, if you're too long and too overloaded and too much on the speculative side, you kind of reduce that. Do you reckon that is what has been happening?
See, there are two parts to it. One is what's your view on elections? And second, and rather more importantly for folks who run risk, is what's your framework? I think on a political macro, the framework should be Modi, weak Modi, or no Modi. And I kind of bring it down to in an election in a country like ours, because he is so hegemonic, and discontinuity there would mean extremely divergent policies. And there's sort of an important macro here that, first time in last 40 years since 90s, the opposition camps' economic policies are so divergent from the incumbents that, there is a huge wedge now. In case there were to be something, even though of low probability were to happen, you will have to reset all market and, which most importantly bonds, currency, but also to a certain extent equities. So I think a return of strong Modi, of course, is business as usual. Return of weak Modi essentially is a listless market and sort of a 3-4 years of a relatively sort of weaker macro, so to say, at margin. As state elections unfold and his hegemony and the policies hegemony of the incumbent actually weaken. And no Modi, of course, is all hell break loose, especially bonds have to reprice, significantly higher inflation, currency has to weaken by 3%, and all these sort of heft that, in terms of P and other valuations sort of market has put on since 2014 has to pretty much unwind. Because that, not because, of anything else, but the economic policies of the opposition is going to be very, very different. So that's the framework you should use. What's your view? I mean, everyone has a view in this country as to who's in what form the next government will be.
What's the global framework? You believe the global structural setup is conducive for global risk and commodities. Tell us about your thesis.
Structurally, see, commodities essentially is a China proxy, and it's, even though China is weak relative to pre-COVID regime, but it is certainly gaining traction. The consumption part, of course, is still weak at 3% or thereabouts retail sales growth. But in general, if you track IIP, electricity demand there, PMIs, sort of everything seems to show that things are picking up. Something similar could be said for even Europe. Even from a monetary policy standpoint, US stands alone. We've seen, Sweden actually cutting rates. So this time the West is not together. And the high rates are actually hurting rest of the world a lot more. And therefore, there is this case to make that, you will have softening of rates in rest of the world, even when, Fed actually dither. Now, that sort of regime is what I see over the next 3-4 months. And then eventually, even Fed begins to cut for all the reasons that we've discussed many times. So that's the setup, which could, because, commodities are proxy to China and other places instead of just US, I guess, it's likely that commodities do decently well.
And what about the India structural? Of course, in India, everything looks good. The macros are strong, resilient. But what are the cyclical trends that you've picked up?
India cyclically, of course, outside of politics, India has, let's say, two parts, capex or investment. I think household balance sheets are leveling up and there's a decent traction there. So after a very long sort of re-leverage of household balance sheet, actually it's accelerating. It's not thawing yet. Industrial capex actually still soft, but it's certainly better than what we've seen in last few years. So it's sort of a return of 2019 like setup. So that's on the capex side cyclically. On the other side, which is consumption, household consumption, which actually forms a large part of GDP, that sort of still remains very, very weak. Especially, when you look at data through staples and stuff like that, we sort of realize that a large part of household balance sheets in India are stressed likely and, are not levering, are not actually consuming. So there is sort of a split there. There is a decent chance of a capex recovery for next 3-4 years, but absent that, India would actually struggle. But my bet is that there'll be a reasonable capex recovery, at least cyclically.
Okay, cyclical recovery. Broadly speaking, and we had Nathan Sheets of Citi in the morning with us, Manish, and I was asking him whether, generally speaking, it's a very conducive environment for risk assets through the course of the year in major markets, right? And his answer was yes, because the rate easing cycle, etc. The promise is there. The when is the question, and promise is something markets can live with as long as it is there somewhere in the horizon. So it keeps one excited, keeps one looking forward to the future. And it's not as if, a big hiking cycle has hurt markets in any big way, but I guess we'd like easing. So just your thoughts, would you agree with that kind of a view, Manish?
So, yes, in a sense, market is in this setup where it desperately needs bad news. And the bad news is good news adage, which worked until about a few years ago. It's only post 2021, the bond equity correlation broke. So we are in that setup. Equity is looking for bad news, but not very bad news. So in a sense, mild slowdown, and inflation sort of continues to sort of taper off. That's the regime that equity wants and is pricing in. Of course, there are other alternatives, other possibilities and sort of decent chance of it. It could be a hard landing, which is a recession setup in which, rates go down dramatically, but equities don't rejoice because, the first order impact is on the EPS. The earnings actually drop. The Q4 earnings in, let's say, S&P is baked at 15-17% higher in terms of analyst expectations. There is a decent chance that there'll be a huge disappointment there if there were to be recession in next 3-6 months. So that could be an alternate setup, and you can't say that there is no possibility of that. And then, of course, there could be a very, very hard land, a very, very bad scenario in terms, the growth slows, but inflation stays tight. In some sense, in last 2-3 months, we've seen this, right? Last 3 months, inflation has been stubborn in US particularly. And in last 1.5 months, you've seen a PMI relapse. NFP data has been weak. Yesterday's, the job loss data sort of all suggest that, the slowdown, albeit slow, is still sort of progressing. So that is a setup that equity won't like. So in this framework, I think the first that let's have bad news, let there be a softening of sort of economy and lower yields, but not such a bad news that it impacts the EPS is what, equity is hugging to. It has a 1/3 chance, let's say, but, other two possibilities are quite malignant.
Manish, thank you very much for joining in. Good conversation. Polycab's Q4 numbers are up for your new screen, and it's a beat on the revenues and on the margins. Revenues for the company have come in at 5,592, so 5,600 crore, higher than estimates, which was sub 5,000 crore, and even on the profit, 550 crore versus an estimate of 480 crore.
This looks like a 10% beat straight, right? On
Straight,
both
yeah.
revenues and profits. So it looks like a very strong number and high interest stock in that sense, because of course what's happened over the last 6 months or so, that dip, and then of course a full recovery there back to where it was. Stocks moving as we speak, 2% higher now. Margins, I think, are also going to be interesting and important. And we'll have that up coming up on the screen in just a bit from now. So reacting to the numbers, Polycab It's been, of course, the market leader. It's gained the maximum amount of share over the last couple of years. And of course, I mean, in the recent past, you've had newer companies, not newer companies, but newer listings in the space like RR Kabil, etc., which have made it to the market as well. Margins have come in. Okay, that's 13.6 as compared to 13.9%. That is the margin picture coming through. So on the margin front, it's not a beat, and maybe it's about a 20-30 odd basis point miss as compared to what the poll here really had suggested. But more details with our team in just a bit from now on these numbers. We'll take a quick break here. We're back with more.